Welcome to Investors Insights. Our topic today is Golden Cross. It's a great topic because today at Five Plan Partners, we're going to pull back the curtain and let you see some insight on technical analysis versus fundamental analysis and the debates and discussions that we have in our meetings. I'm joined by my distinguished colleagues, Bobby Norman, Trey Booth, and Ty Miller. We've had a great meeting this morning. And before we get into the details of Golden Cross, I just want to mention to everybody that everything we do here at Five Plan Partners is tied together to keep you informed in regards to your financial blueprint and in relation to your portfolio. Case in point, I recently sent out my beginning of the year letter on thoughts about 2023. In between them, we've been doing the vlogs. In the next couple of days, you're going to receive another letter with more information related to the information we're giving you today. And the other thing is, because we want to interact with you, on February 8th, we're having an Investors Insights here in our office. And on February 9th, we're having a virtual meeting for our clients across the country. And with that said, it's so you can get our understanding of where we are as an economy and how that relates to you, your portfolio, as well as your financial blueprint. So why the topic Golden Cross? Bobby, you started us off with technical analysis this morning, and I need you to explain that.
Yeah, so after a strong January for the markets, the question is, can the rally continue? And fortunately, technical analysis helps us answer this question. In one bullish market development that happened last Thursday, and for the first time in 2 years, a golden cross occurred in the S&P 500. So as you can see in this chart, a golden cross is a bullish signal when the 50-day moving average, which is the orange line, crosses above the 200-day moving average, which is the blue line. Historically, a golden cross means a positive market. No guarantees, but it's a good sign for the market. As seen in this next chart, the S&P 500 has historically tended to generate positive returns over the next 12 months following each golden cross. Of the previous 36 golden cross signals, the index produced forward average 12-month returns of 10.5%, seen in the blue line on the left side of that chart. What's more interesting is on the right side of the chart, when the 200-day moving average is declining, which we see today, the average return for the S&P 500 jumps to 16.8% over the following 12 months. Again, seeing the far right blue line. So we're able to analyze the technical analysis for confirmation that there is a trend change for the market and further raises the probabilities that the bear market low that we saw back in October and the current direction of the market appears durable. Just probably not at the same pace we saw in January, but a very positive sign for the market going forward here.
Yeah, that's a great update, Bobby. And let me say this to our viewers, is that like in 2020, a lot of the fundamental analysis, no one knew how to look at businesses and the economy under the 2020 COVID year. And technical analysis played a key role as to how we moved money in our clients' portfolios. We've always embraced fundamental and technical analysis. So on the fundamental side, in relation to what Bobby just talked about technically, is that, Trey, you talked about the Fed, you talked about what's going on there. Everybody's been watching interest rates increase. It's a fundamental occurrence there and the impact of that. So help our viewers understand and elaborate on about what's going on with the Fed as compared to what Bobby just talked about in the technical analysis side.
Yeah, absolutely. Thanks, Greg. So as we've been talking for last year or so, is the Fed is driving the markets. The old saying, don't fight the Fed, has definitely been true. So the Federal Reserve met last week and announced their interest rate policy. As expected, they raised rates by a quarter basis points from 4.5 to 4.75 as the top line. So that was in line with expectations. It's not nearly as aggressive as they closed the year, where they were raising rates by 50 basis points, 75 basis points at a time. So the Fed appears to be slowing down. The market took that positively. However, dug into their official statement was one sentence that was missed initially that the market may be taking as more aggressive. And I'm going to directly quote it because it's a lot of Fed speak, so I don't want to misspeak, and then I'll summarize it. But Federal Reserve Chairman Jerome Powell said, The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. And the end there is an important number because many market participants have been looking for the federal funds rate to get above the current rate of inflation. So the current rate of inflation at 6.5, Fed rate at 4.75. That's not nearly as far to go, especially with two inflation numbers coming out, with inflation falling between now and the next Fed meeting in March. You could easily see how inflation could fall down to where the Fed is currently. However, with inflation at 6.5%, that's a long way from 2%. So is the Fed moving their target of getting the Fed funds rate above the current inflation rate, or are they trying to get inflation all the way down to 2? So that's a much more aggressive stance if the Fed's going to remain aggressive until inflation hits 2%. So kind of some mixed signals there. So if you don't want to fight the Fed, it's kind of hard to see where they're going. But a lot of data to come out. That means that the next most important data point we're watching is the inflation report that comes out on the 14th of this month, because we got a little while before the Fed. But so that's what we're watching very closely. Where is the Fed looking? Current inflation or all the way down to that 2%? That was a very restrictive policy statement out of Federal Reserve Chairman Jerome Powell that he kind of snuck in there during a very dovish statement.
No, you're absolutely correct. And it also emphasizes why we have to stay on top of things here. I mean, we're watching day by day, week by week on the fundamental analysis, comments by the Fed chairman, actions of the Fed. Simultaneously, we're watching the swings in the market, the golden cross and the technical analysis there, and then putting numbers to it. And throughout the week, we will continue to update people on this in regards to our social media, LinkedIn, Twitter, on our podcast that we have on YouTube. So we will continue doing these things. But in terms of numbers, Ty, you brought up the numbers aspect of good old-fashioned corporate earnings, which is a must in fundamental analysis.
Yeah. So far this quarter, we've had half the companies in the S&P 500 report earnings. As you can see in this chart, sales growth beating expectations, up 4.6%, but earnings growth coming a little bit short, negative 2.7%. Again, in this chart, you can see energy still the outperformer. But what's interesting is, that kind of gives us the perspective of right now. And, as Trey mentioned, as the Fed continues to do what they do and see how we're going to go about things, if they're trying to get inflation down to 2.7 or just, kind of cross over inflation. We have the 2023 numbers and they have started to come down. Every time that the company reports, they put out an earnings estimate. And so far, they have been coming down to, where we started last year was around $245, $250 for the entire S&P, down to $224. As you can see, it's been a pretty steep decline. It'll be interesting to see, some things that aren't factored into these earnings or, job cuts. We've seen a lot of job cuts, which are never good for the employees, but it does help companies expand their margins, less cost. Inflation numbers, of course, help sales growth, but it also, factors into earnings cost or cost of goods sold, things of that nature. So it'll be something to keep an eye on going forward, the earnings perspective as a whole.
Well, and as we're tracking earnings and then looking at what the Fed's doing, looking at the technical analysis, going forward, there may be good opportunities of entry in the markets, for us to look at for our clients in relation to their financial blueprints. So just for what that's worth. And we're in a unique environment here that we haven't had in some time, in which we can not only evaluate what's going on in the stock market, but also in terms with interest rates going up, there may be interest-bearing accounts and those kind of things that we can bring to the table for our clients also. So in this market movement, we've got a lot of variety that we can do for our clients as we work towards getting to their financial goals. So for this 2023 year. So with that said, we hope you'll watch out for your invitation to Investors Insights, either on February 8th or the one on February 9th. Also, later this month, February is big for us. We will, on February 18th, we will begin our 18th year here at Five Plan Partners. And we've been through a lot of markets between 2008 downturn and COVID. We have weathered those storms and navigated for our clients due to fundamental technical analysis and also keeping on track with your financial blueprint. Historic times, we always are thankful to have you in our lives and to have the trust and confidence you place in us. And just know that every day we are striving to see to it that our clients have a better, richer, fuller life. We hope you have a great week, and we hope this vlog has been very beneficial. Watch out for the next letter that should come out in the next day or two. We're going to keep you updated. Thanks.